One of the places that risk assets have seen some of the deepest pullbacks, even before the interest rate driven revaluations that we've seen in the last several weeks here, has been in the Chinese market, has been many of the US listed Chinese names and technology specifically in media that have taken an absolute shelling over the course of the last 12 to 18 months. A lot of that in the initial stages was because of what was perceived, and what I'll just call, because I'm in the West and I don't have to fear the sanctions from these guys, is a government campaign to crack down on these companies, right? That really kind of hammered them a little bit. I'd like to take the time that we have left here to address an issue that both of you have some familiarity with, and that's the Chinese market. It's been very geopolitically sensitive given the current environment between China and Taiwan. Semiconductors have been at the front of that story. Many of these Chinese tech giants have been at the center of that story. I wonder, Jim, from your standpoint, are there still places where China has companies that are doomed to revalue to the downside even further than they are right now? And if so, where?
I'm going to handle that question, deflect that question a little bit, and point out something perhaps even more ominous. And that is, if what is going on in the world, whether it's Russia, Ukraine, whether it's central banks losing control, whatever it might be, weren't happening right now, I think what would be happening in the Chinese real estate market would be front and center for investors. It is, I've long said that Chinese apartment prices are the most, probably after treasury bonds, most important asset class in the world. And they are declining. We are seeing a real estate problem in China over the past 18 months that the government does not seem to have a handle on. And the reason that's important, as you know, is that investment is still almost 50% of the Chinese economy, and that residential real estate is almost half of that. So residential real estate is 20 to 25% of the Chinese economy, which is a stunningly large number. They're still building 15 to 20 million flats a year. And the fact that there is a major meltdown occurring amongst the developers, both public and private over there, is a major story that's really kind of on the back pages of our financial press.
Are you saying that Evergrande is just the beginning here?
Evergrande was the start of it. That was 18 months ago. And there was another default, I think, just this overnight in a different developer. You have to understand that, like Tokyo in the late 80s, almost every large company in China has a real estate development arm. So it's not just the developers. This is endemic to the whole economy there. And I think that we ignore it at our own peril, but realize just how much of Asia is tied into China. It's a big story. And I think we're kind of all, because of other things, it's off the thing, and a focus on tech stocks, as you say, because mostly it's tech stocks that trade in the U.S., Chinese tech stocks. As Joe Tsai reminded me a number of years ago at Delivering Alpha here, that I didn't understand Chinese companies. You know, it's a tie-in with the government that you cannot get away from. It's the state economic model, whether you're publicly traded or not. And capital going into China just is not treated well, and particularly Western capital is not treated well in China. And this has been going on now for a long time, not just the past few years.
Carson, where does it manifest itself the most in your mind? What does your gut tell you about whether or not there is any kind of a real shoe that's left to drop here when it comes to Chinese companies and their economic viability in this kind of environment?
Well, what the past year and a half have really brought front and center is, I mean, like Jim was just talking about, the state involvement in the economy. And until about a year and a half ago, just would always hear Western economists laud the government in China. Oh, the government's going to do this, the government's going to do that. And these are the same economists generally who freaked out when the U.S. government got non-voting pref stakes in our banks. You know, so it's like there's always been this cognitive dissonance there. But in the past 18 months, investors have really been smacked in the face by the fact that this is not only a totalitarian regime, but it's also capricious. And Xi has clearly judged that he no longer needs or even really highly desires Western capital. So you're rolling the dice. if you take a look at a lot of Fortune 500 CEOs, they appear pretty sanguine. And you might say, well, you know what, if these guys, if they're okay with investing more money in mainland China and they're not really panicked, and this also ties into the scenario in which China attacks Taiwan, if they're not panicked, maybe I should be okay with it. But I would point this out, and this is a reality of the world. I mean, certainly you see this in asset allocation. If you zig when everybody else zigs and you all zig off the cliff, you know, you're not going to really suffer adverse professional consequences for that. You zig when everybody else zags and it doesn't go well, then you're going to have a problem. So just because all of these people, all these Fortune 500 CEOs are willing to increase their bets in China that they had already made, you know, don't take that as them being the smart money here. And by the way, the China invasion of Taiwan, the scenario in which China invades Taiwan, I mean, it is the biggest issue. There is no issue in investing in China or Asia that surpasses that. And, you know, like how do you know? Like, how do you know whether do you really want to bet that China does not invade Taiwan? Like, what's that based on? You know, because they need the U.S.? I wouldn't make that bet.
Does that mean that Chinese-based, or I should say this, Taiwan-based manufacturers and semiconductor companies are, in your mind, a hold right now? Don't touch them?
Well, it's interesting because if you're Taiwan, on one hand you could say, hey, the smart thing to do might be to build fab capacity elsewhere in an area that can't be attacked by China. But on the other hand, if you want to make sure that the U.S. and the West rides to your rescue, you don't do that. So, yeah, I mean, look, I don't deal in holds, but there's obviously a lot of risk there, and you know, there's a price for everything. But do the prices of these assets really reflect that risk? It's what you have to ask yourself.